Yo my people, back again with another video, and this video is going to be based on draw on liquidity and daily bias, and I've got a bunch of screenshots and I'm going to take you through a few examples on the actual charts as well, just to show you how it looks in charting scenarios. Onto the video now. So the easiest way to frame a draw on liquidity or a daily bias is to use previous days highs and lows. For example, unless price is going to consolidate, we expect price to either reach for a previous day's high or low depending on the candle's closure. So for our first example, as you can see here, we have the first candle's range, then we have the second candle open. The previous candle closed close to its high, so we expect price to move higher and take out previous day's high. On the flip side, we have this candle's range, and then the next candle, the previous candle closed close to the previous day low, so we expect this candle to reach for the previous candle's low. For our second example, previous days highs and lows can also be used as liquidity pools to frame reversals. For example, you can see here we reached for the previous day's high, we swept it and then closed below the high, which sets us up for a possible reversal pattern to the downside. And in the second example, we reached for the previous day's low, reversed and closed above the low, which sets us up for a possible reversal back into this candle's range. And in the third example, piecing it all together, we have this candle's range, then we have this candle sweeping the previous candle's high and closing below it, which we can anticipate a reversal to target this candle's low and possibly this candle's low, which we have. Then this candle closed close to its low, so we'd anticipate the next candle to reach for that previous day low, which we did. So we swept the previous candle's low and closed above the previous candle's low, which gives us a reversal. So reversal framed off of previous day low. And then we have a candle closure close to its high. So we anticipate previous day's high as a draw. Then price closed close to the high again. So we anticipate another previous day high as a draw, and so on and so forth, until we reach our draw on liquidity, which is this possible high here. And now, moving on to a few charting examples, we have the gold, and we're trading on the daily time frame. So as you can see here on this candle, price closed close to the candle's low, so we would expect this price to take out that low, which we got. Now this candle price closed close to its low, so I would expect price to take out that low as well, but we didn't get that. So the next draw on liquidity would be this high, as price closed close to that high. We got that with a huge push to the upside. We also broke above these highs as well. So the next draw would be this candle's high, as price close to its high. So we swept that high with that candle's wick and we closed lower. So with price closing close to this low, we would expect price to sweep that low as well. We also have a little fair value gap in here, so we want price to sweep this low and dig into this fair value gap, which we got. So price completely rebalanced that fair value gap with this long wick, and it closed close to this high, so we'd expect price to reach for that high and move higher, which we got. And then price respected it with a long wick as well. Price is closed in the midpoint of this range, so it's closed close to the low and it's closed close to the high as well. So what I tend to do is sit on my hands when it comes to that. and then wait for the next candle print to give us more clarification as to where price wants to go. So this close was close to this high, so now we would expect price to reach for that high, which we eventually got, and then price spiked through it and then closed respecting that high. Another thing I like to look for are previous week's highs and lows. So for example, on the left hand side, we have a weekly range where I've marked out the previous week's highs and the previous week's low. The previous week's low was then used as a reversal point. So we got a sweep below previous week's low and a closure above the low. So ideally from here, we would like to see price move back into the previous week's range, or we can look to target the previous week's high. Or the previous week's highs or lows could just be used as a form of a draw on liquidity. As you can see here in the example on the right hand side, price retraced back into the previous week's range and completely rebalanced this fair value gap. And then we got a move back to the downside, targeting the previous week's low and using that as a draw on liquidity. So price drew towards it and took it out. Now moving on to some charting examples on the previous week's highs and lows. We have a weekly range here, and I've marked out the previous week's high and the previous week's low, and we're going to see what the next week does. So we're going to print these candles out till Friday. So what we got was price moved lower, it took out the previous week's low by a tiny bit, then we got a move higher, it completely closed above the previous week's high, then we moved back lower to go for a previous week low sweep, and we dug a bit deeper below that previous week's low. What'd you say? No, what'd you say?
Smells like Patricia as well.
Moving on to the next week. Let's see how the weekly candles print. So as you can see, we didn't really get a draw to any highs or lows. So the week just traded within the previous week's range, which signals accumulation. Moving on to the next week. Now we just used the previous week's low as a draw on liquidity. So this candle here, we got a little spike above these two candles low, and we traded into that fair value gap, and then price displaced lower to take out the previous week's low, and we got a full candle closure below the low. And for the last example, we're going to see how these candles print. So as you can see, we completely left the previous week's lows alone, and then price continued to deviate to the upside towards the previous week's high. We got two full candle closures above that high, and then we traded back into the week's range. In this next part of the video, I'm going to be talking about swing points, failure to displace, and the next day model. If you do not know what swing points are, then go check out my video on liquidity, and I'm going to leave the link in the corner of the video on the right hand side. And now moving on to swing points. With swing points, I can use them to frame a draw on liquidity. For example, on the left hand side, price is trading towards the upside, and where is it likely to draw towards? The swing high, where buy side liquidity resides. I can also use swing points to frame reversals. For example, on the right hand side, we have a swing high, price moved higher to sweep that swing high, and closed below it. So we could then anticipate for our next candle to print lower to form a reversal towards the downside. That now brings us into the failure to displace. So as you can see here in the example, if price fails to displace below a swing low and closes above it, then we could possibly see our next candle move to the upside. And then on the flip side, if price fails to displace above an old high and closes below it, then we could possibly anticipate the next candle to reverse to the downside and give us a bearish bias. This then finally brings us into the next day model. So with the next day model, using PD arrays and old highs and old lows, here when price fails to displace below an old low and then it closes above that old low, would anticipate for price to move higher. So on the next candle we'll get an open, low, then high, and then close, and then we continue to the upside. And then carrying on, we see how this plays out. Then we reach the old high where we fail to displace through it, and then we close below that old high where we'd anticipate a bearish candle. So we get an open, high, low, and then close, and then to the downside we can get a possible move lower. Again, looking at another set of price action, you can see that we had a sweep of an old high and then price couldn't displace above it, so we got a close below. So we'd anticipate for the next daily candle to print lower. So we got an open, high, low, close, then price continued even lower. Then we had a retracement back up into a PD array. So the PD array was a bearish order block. So the last up candle before the down move, price rejected off that and closed below it. So we'd anticipate the next candle to print bearish. So we got an open, high, low, close. Price closed close to its low, so we'd anticipate the previous day's low to be targeted. So we got the open, high, low, close. So we took out the previous day low, and then so on and so forth. We got previous day low, so we got open, high, low, close, and then we targeted another swing low here, which we now use as a draw on liquidity. So price drew from the PD array and then it drew towards the swing low, which was then targeted. Moving on to the last part of the video, I'm going to take you through a top-down analysis of a trading week, or two top-down analysis examples of a trading week that I would go through and where I'd start from. So looking on the weekly time frame on the GBP USD, I look for my PD arrays and possible areas where price could reverse from or go to. So here we have a weekly order block, so it's 2 consecutive up candles before the down move. So I'll draw my weekly order block there. So we have the previous week's candle move up into that weekly order block, and then we had a strong wick rejection to the downside. So what I like to do is I'll get my Fibonacci retracement tool, and what I'll do is I'll draw the range to see where the candle closure was. So it is pretty close to the midpoint of the week range, but because it closed below the 0.5, so the halfway point or the equilibrium of the last week's range, I do expect price to draw towards its low. So the previous week's range low, that's where I would want price to draw to. So I'll draw my sell side liquidity to there. So that's my point of interest for the week. So Now I'm going to drop down to the daily. Now let me do it to the hourly. So on the hourly time frame, what I do is, because I trade from midnight Eastern Standard Time, I trade from midnight to midnight. So what I do is I look at Friday's candle, so the previous day's candlestick. So the previous candle, which was Friday's candle, Friday swept the previous day's high, which was Thursday's high and Monday's high, into that weekly order block and then displaced lower to the downside. That displacement lower to the downside, it broke market structure here. Put a light bulb here to show. So it broke market structure below this low to the downside, and then it formed an order block. So the order block is this last up candle before the down move. So we've got a full candle closure below that order block. So we're going to label that a 1 hour order block. So price swept Thursday and Monday's highs. So those are swing points. Those are swing points in a market that Friday swept, and then we got a close below that high, and we got a close below Thursday's high as well. So that signals a possible reversal to the downside. And on the weekly time frame, as we outlined, we're looking for bearish prices. So we're looking for price to deviate towards the previous week's low. We also have equal lows here that price loves to target in the market. As you can see here, we have equal highs, price deviates towards that. Got multiple equal lows here where price loves to target, digs into it and it moves higher. So if we're looking to target previous week's lows and we have equal lows here, that gives us more clarity that we want to see lower prices to the downside. So this displacement lower has formed this 1 hour order block. What I would want to see is price retrace into this order block and then displace lower to the downside. So I'm going to print out the candlesticks. So what we've got now is prices retraced into the order. Let me zoom in. So prices retraced into that order block. We got another market structure shift. So prices moved into the order block. It's respected the midpoint. So that's that middle line. It's respected that midpoint. It's formed another market structure shift within that order block at the midpoint of that area, and then it's displaced even lower to the downside. I wouldn't have taken short positions here because if you go on a 4 hour time frame, computer's starting to lag. Placement here, I wouldn't have, although we got this market structure shift and a displacement to the downside, I wouldn't have taken this trade here simply because one, it's the end of the day. So we're past the London close, so it'll be best for me to wait for the next day. And second of all, as you can see on the 4 hour, we had this displacement higher into that order block. It formed a fair value gap, so it'll be better to wait for a 4 hour close below this fair value gap, which we got during this candle. So if I draw an inverse fair value gap, I'm going to talk about an inverse fair value gap on another video. So we've got an inverse fair value gap there. Let's do that 4 hour. So price closed below that. So that's signaling more bearish momentum now. So like I said, the overall bias on the weekly bearish. So price is showing signs that it wants to target this area. So now I'm able to look for setups to the downside. We had a fair value gap, a little fair value gap. So I'm going to label it 4 hour fair value gap, where price went into it as you can see on the lower time frames, this candle here, it rebalanced it, it went to the midpoint of that fair value gap, and then it displaced lower. That's what caused that displacement to the downside to close through that previous 4-hour fair value gap, which means an inverse fair value gap. So if you look closely as well, this move higher, it swept this high and it swept this high as well, making it a protected high. So it's already done all the work here and it's displaced lower to the downside. So if we get a retracement back into this range that's been formed, we could look for our sell positions to the downside. So on the higher time frame, on the 4-hour again, we have another 4-hour fair value gap there. So that's that range that price is traded into. So it's traded into that 4-hour fair value gap where we could enter our sell positions. And then I'll just put my stop loss above that protected high. So that high that was formed, we put above that protected high. And then for the rest of the week, just look to target those weekly lows. And then price just displaces to the downside. And then reaches those weekly, and then reaches those weekly lows and then takes us out for the week. So ideally, that's how you would want to frame your trades. On the higher time frame, look for the weekly bias first, so you know where you're going for the rest of the week. So that just filters out a whole load of, so it just gives you clarity, so it filters out all the losses, so you won't be going back and forth. So if price moves higher here, you wouldn't be chasing long positions. So you know, and you have it set in your mind that no, although price is going higher, I'm just looking for shorts. Even if you don't get shorts throughout the week, still don't force it. If a week passes and you don't get trades, don't beat yourself up about it. There's always setups. You move on to the next week, but you'll definitely get a setup. That's where a lot of traders go wrong. They start to force biases, and that's how you blow accounts. Stick to your bias. Stick to your positioning, and you'll see what that does for you. So I am going to do one more top-down analysis example, and this is going to be on the MNQ, so the Nasdaq 100, and we're going to start from the weekly time frame. So as you can see, on the weekly time frame, price is in a bullish state. So we're respecting bullish PD arrays and disrespecting bearish ones. So we disrespected a bearish fair value gap here, where price rebalanced this fair value gap with this candle and then moved higher. That move higher broke through this bearish fair value gap, so we disrespected that and we respected this one. Now price is currently here at this bullish order block, so got the last down candle before this huge move to the upside. So draw an order block and then label it as a weekly order block. And because we're bullish right now, the next area to target is the previous week's high. So this candle's high is what we would look to target for the coming weeks. So we'll label that as buy side liquidity. So because this candle closed close to its low, I would expect a sweep of this candle to the downside into this bullish order block and then move higher to the upside. So we're going to go to the lower time frames and start the week. We're going to 1 hour. So we have, this is the previous week, and we're going to look to target the previous week's high. We've got equal highs here So this is pretty equal, or low resistance liquidity ones where price would look to aim for, and you could also class this as an original consolidation. So what we would look for now is a sweep of the previous week's low before continuing higher throughout the rest of the week. So we'll print out those candles. So into Monday. So I'm not going to look for any long positions until I get a sweep of Friday's low or the previous week's low. That's only when I'll entertain the market. So with this huge push to the downside, we got a sweep of Friday's lows. But because it was such a small sweep of that low, I would need another leg higher before I could entertain this market. Because that sweep was so little, price could go back to digging deeper. So until I get something like this, and then another leg higher, that's when I would entertain it and then look for my long positions to go higher. But right now, because that sweep was so, shallow, price could easily go back down lower for another sweep before continuing higher to the upside. So just let that run out. So yeah, we have a market structure shift. Just label that there with a light bulb. That's our market structure shift to the upside. So it's now that we have that sweep of the previous week's low, and then that market structure shift, it's giving us signs and signals that it wants to move higher. However, like I said, that little sweep, I'm not convinced yet. But still, we'll go to the 4 hour, we'll mark out. That's a 4 hour fair value gap where we could look to enter and then make another leg to the upside. So, still gonna print. So we had a run, we disrespected the fair value gap on the hourly. But like I said, I'm still not entertaining it because I'm still not certain of this area here. If we get another leg higher and take out this high on Thursday, then I would look to entertain the market. So we've got to push higher. Still, yeah, we've got a slight break above that on the Thursday. So if I go on the 4 hour and mark this out now as an order block, because the fair value gap was disrespected. I can now go back on the hourly. So on the 4 hour here, you can see that we have a swing low here. So we have a swing low here that was swept by this candle, but there was a failure to displace below that swing low, like we mentioned in the previous topics at the beginning of the video. So we had a failure to displace, and then we got a close way above the low, which signals a reversal. So these are signs that price is willing to move higher now. If we go on the 1 hour, like I said, I wouldn't entertain this market until I got a close above this high. So now that we have a close above that high with this candle here, then we got a sweep of the low and then a close above the low. So it was a failure to displace. We've displaced through a previous bearish fair value gap, so we're disrespecting bearish PD arrays. So that's that 1 hour. Now it's an inverse fair value gap, and now we've created a bullish one. So we could look to enter our positions on this fair value gap. So we have a 1 hour fair value gap that's being respected right now. There aren't any other fair value gaps where price could possibly draw down to move higher, so it would be good to take a trade off of this one, and then we could put our stop losses below that low, and then we'll just look to target that. That is a 1 to, it's about a 1 to, probably 1 to 2, no, 1 to 1.2, sorry. So we could just put it below that sweep, and then we see how it plays out. That's horrible price action, but it still respected the range that it's in. This is just a quick example. And then we finally moved higher to the upside to reach for our target areas. But that's just a quick example. In a real life scenario, as soon as we got to around these areas, or even to take out this high and then reach for these areas, I would have taken off partials, but because it's on replay mode, I just let it just play out. But yeah, price still, as price moved higher, it was still trading within this range, but because this low was swept, price has already done the work here and it's displaced higher, so there's no reason for price to move back into this area to take price out. It's already done the work, and its objective now was to take out the previous week's high that we marked out at the beginning of the week. So yeah, as you can see, that inverse fair value gap that was taken out, it came back down to respect it. It didn't even trade below the inverse fair value gap's consequent encroachment, so the midpoint of it. Look how the bodies were respecting that area. Went back into it, respected it again, and then it moved off higher to the upside. So like I said, I would have taken off partials in a real life scenario, but because of video's sake and replay mode's sake, I just let it play out to where we were looking to target. But yeah, that's that for the video. If you found it insightful, drop a like, subscribe. You could comment as well if you like. But yeah, if you want to see more videos like this, yeah, just like and subscribe, and drop a comment to request what topics you'd want me to drop a video on. And yeah man, that's that for today. Safe trading.